You are listening to Mining Stock Education.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers, with Brian Leni, my co-host. And in today's episode, you're going to hear us discuss in our monthly Junior Mining Insights chat, where we prioritize process over picks. Brian, thanks for joining me. It's been a volatile time in the market. You obviously have portfolio exposure. You have subscribers that are probably emailing you, asking you what to do. What do you make of all this war in Iran and how it's affected the markets?
It's been interesting to see how it's unfolded. I think more than ever, what turmoil brings is it really tests investors in terms of their conviction in what they own. And I think probably one of the biggest things that I shouldn't be surprised about is that there is, a lot of clamor or a lot of tension from investors that aren't sure what to do, aren't sure which picks necessarily to hold in their portfolio, what to sell. So I think a lot of disarray, and I think that's synonymous with these sorts of phenomenons. Like you go back to the COVID hysteria. I can go back further to like the 2008 crash, and I wasn't in the market as deep as I am now, but I remember what was going on around me. And again, there's a lot of fear, a lot of uncertainty, and that leads to sort of the selling and the big drops that we've seen on these individual days of trading, going back to sort of January. And you can blame January on maybe a more of like a euphoric top. But since then, the conflict in the Middle East has certainly taken over, and I think is really testing investors to what they believe in and what they don't. And it should definitely be a good learning experience for everybody. Each one of these like sort of high calamity events has been a huge deal on both on the positive and the negative for me. And so, you're not going to play it exactly perfect, but this is a time to certainly learn and hopefully benefit from in the future.
So when you see huge drawdowns in your portfolio, what are your emotions like over a week in which your portfolio drops by 35%? How do you manage that?
It's definitely tough to watch when you're in the midst of it, but I think I take a different approach. I think that a lot of people, in terms of, and we've talked about this in the past, my willingness to sell, to take profits, and sort of move money around. I've been sort of preparing for this kind of, I don't want to say likely event, but some turn in the market for more than a year now. From taking profits in gold, moving a little bit into copper, and then taking profits from copper and gold in January and February, and sort of being in a really good cash position today. And I've tailed back positions to weightings that, I'm pretty comfortable in, sort of no matter where we move forward, because I think the catalysts that the company has could bring share price appreciation, maybe regardless of where we are. Now that's sort of subjective and may take a little more time. So what I'm trying to say is, like, I try to position the portfolio and operate as if, a black swan or something could disturb the market. And I always want to be in a position where I can sort of react to it positively and not act irrationally, sort of like what I was talking about in the first kind of topic question we were covering. I think the tendency is for people that don't have a good grounding in what they own and what their strategy is, that you succumb to fear and you're looking to sell, you're looking to push stuff out of your portfolio as soon as possible. And I think that can be a big mistake, especially because we don't know exactly how this is going to break down, and whether we're in for a long drawn out conflict in the Middle East, or whether this thing only has a week or two left and we can actually and hopefully head towards some sort of a peace agreement. You just don't know how it's going to break down and how it's going to trickle down. We do know that the Strait of Hormuz is going to have a huge effect on commodities and life in general, and the trickle down effect, even if it doesn't affect North America right away, these things that affect, East Asia, it looks like it's going to be the most impacted in the short term. We're so connected still, that it's going to have a trickle down effect, and how that exactly breaks down, I think you can come to some conclusions, but much of it is still sort of up in the air. So Yeah, it's definitely always tough to see especially after your portfolio has moved as well as it has, to see like a 25-30% retracement. But I think in most times this is opportunity to buy more or to pick up other good stories and add them to your portfolio while maintaining some sort of cash position or some way of capitalizing on further opportunity if this thing gets worse. So yeah, I guess that's both general and specific to what's going on today. How do you approach it? Like, especially when it comes to, like, one of the big questions I would like ask you specifically is dealing with the noise versus signal, and how you separate it in this age of social media, of all these different voices that want to influence you.
So I kind of categorize different voices or what people are saying. Even like, as an example, the gold price sell-off. There's different people that I think both you and I would respect, but they have different interpretations of why gold sold off. It was a liquidation event in large part. No, it wasn't a liquidation event. It was these three factors. And you listen to these different people, and they all have a different interpretation of what's occurring. But then if I step back, like, if you look at the overall sector psychology, especially the last 2 months or 3 months and last year, everything's going up. Everybody's a genius. They feel smart. It turns over. Everybody's a detective and a philosopher trying to explain what's going on. And so just even observing that psychological shift, I think is interesting. And then in terms of like my own portfolio, I took a meaningful position in one company that sold off maybe like 37% off of the recent peak. And I bought it because I knew it well. And it was totally capitalized. That institutions funded it earlier this year with tens of millions of dollars, to where there's not any immediate dilution or financing risk. There's multiple near-term catalysts. I met management personally, been to the project, boots on the ground. And so last year I sold it for a double when it doubled in like 45 days, but it was always on my watch list. And then with the sell-off because of the volatility recently, then I said, where the institutions bought in, that's going to be my entry point. And it went below where the institutions earlier this year put in about $50 million. And then I took a big chunk of it for myself, and I'm up about 35% like in a week off of that bottom already. So that's how I played it, Brian, but I only bought one company as a result of it. And separating signal from noise, I guess I study some of the noise, and it's kind of like, you know how they say the bank teller, to where if you give a bank teller a counterfeit dollar bill, he or she is going to be able to discern it right away because they touch it every day. So they know what the real thing is. So because they know what the real thing is, that's the best way to detect what's not of substance. So I guess in saying that, I filter what I'm seeing or potential opportunities through my own experience over the last 10 years of what works and what hasn't worked. And I don't know, maybe that's not a specific answer, but that's a little bit insight of how I perceive things.
No, I think it is. I think it is, because I think that filter is super important, and how you filter your own experience and how you sort of deduce outcomes from that experience, and what in weighing the past successes versus the times you've been wrong is exactly what you probably, or all that you really can do. The better that you get at doing that sort of dictates.
And I did take meetings too, Brian. I forgot about that. I took a couple meetings with companies with potential investment opportunities that were referred to me. So I did look at some things, but those were direct referrals from people in the sector. And if I could relate it back to our recent interview, when we talked about process and bias. So when you're consuming information, whether that's from two people like you and me, whether that's even from like a direct referral, because I remember even when I was as I thought back after we released that episode, to how you vetted me, even in our conversations, when I brought to you an investment idea once, you were like, Bill, I want to know your bias. I want to know if there's any non-alignment with you telling me this company other than you being a shareholder if I become a shareholder. And so like you want to know the bias, you want to know the process. And so even with the person that introduced these couple ideas to me when I had a phone call with them, I queried them on their process. And one of the things that was clear, and I said, okay, I said, our risk profile with where the share price is now is not the same because you have the majority of your position below me with warrants, and I would be buying in like where your warrants are. So that's a totally different risk profile. And then also through the course of interviewing and thinking things too, Brian, when you have competent, when we've talked about different profile of a guy, or usually a guy, sometimes a gal, in charge of a junior miner or a junior resource company, when you have somebody that's good at what they do, they're technical, but they're outside of Canada, but then they're now operating in Canada, there is a learning curve for like US persons or even Europeans that are going to be in control of a TSXV or a CSE listed company. They have to learn the ropes of how the Canadian junior mining ecosystem works. And so that was a personal reflection via some meetings that I took over the last month.
What about overthinking? This topic came up in talking to a mentor at PDAC, and he was talking about, actually, he was making the criticism of another like junior company within the resource sector, and talking about how management was sort of unfortunately completely overthinking a situation, and it's cascaded into a number of mistakes over the last couple of years. And I was listening to that. I was like, oh, that's pretty interesting. And I agreed with him. And then I thought to myself, I wonder how that sort of parlays to investors. And I think when you get into situations like this that we're in today with the conflict in the Middle East, my inclination is to say that this could be one of those opportunities where overthinking could probably come into play, maybe trying to get too cute with your portfolio and such. But what do you think about the topic of overthinking and how it might apply maybe first to an investor, and then if you want to talk about a company executives?
So well, if I could start with a company executive, because as you said that, I thought of a specific executive that I invested with and didn't make money. And his overthinking was based in insecurity and anxiety due to historic and continued lack of performance. So if your overthinking is rooted in that, that's a big problem. So hopefully next time I'll be able to discern that a little earlier. If your overthinking as an investor is like, should I do this, is related that you're too far extended in your junior portfolio and you're spending money on junior mining stocks that you should keep in savings or on your kids' tuition, you should ask yourselves those step back questions. But I think that, like, okay, if I could, knowing you for years now, like a company I invested in that you invested in months after I invested in, you had to go through your process. And even when you said things look good, you would not buy a share until you went through your process. So I think like that's respectable, because even if you miss the opportunity, there's going to be another opportunity. And even when you look at these charts, I went back and looked at a bunch of charts this last week of companies that went up 8, 10x over 2025. And I was just looking like for 2 years, the share price did nothing. It traded between 5 and 7 cents before it started to trade between 47 and 58 cents, right? So there was a lot of opportunity there for you to do diligence. So I think in terms of pulling the trigger to invest as a junior miner, I think you would want to err on the side of like think, then shoot, not shoot, then ask yourself, should I have pulled the trigger?
Totally.
Yeah,
totally.
But your thoughts, there's obviously something behind, why you would bring it up. Yeah.
No. I completely agree. I just thought it was an interesting topic. And, there's certain individuals, and especially ones that I would deem mentors, when they bring, or it certainly, I don't think it was on purpose, but when they bring up topics like that I haven't sort of thought of myself, it just piques my interest. And I honestly, I query myself about, am I overthinking certain situations? I think, again, going back to situations like this, when emotions can be high, when risk definitely, even though it's the most apparent, is definitely there. I think there is a tendency where people can try to be too cute with their portfolio and, trim here, take this, take that, sell. And they're really basing their decisions off emotion instead of logic and probably telling themselves that, oh, I know exactly how the future is going to unfold. And, they don't. And, there's the situation where I think, you look at the COVID crash and maybe you could have said, yeah, this is likely to happen. But I think when you get into those sort of modes, I'm not sure that even if you have the intention of selling and then saying, I'm going to buy back in, whether people actually do it, because I think you tend to stay in that one mode or one thinking style and or emotional state where you're fearful. And then you don't end up coming back into the market because you think it's going to go lower. So like, again, I think that's probably at the root of why I act the way I do, because I try to keep it the same no matter where we are in the market, where I'm buying and selling, not because of necessarily what the market's doing. I can't say that completely. But I'm sticking with the same strategy, the same process, buying and selling. And I think I would say I've been the most comfortable in sort of a chaotic or volatile market this like right now than I have been in the 10 years since prior being a private like full-time investor. And I think to me that's progress.
Or is it because you're sitting on unrealized gains, right? You have the margin of safety. What do you think? And how does it psychologically affect you? Because I've had friends that had 7-figure portfolios and then you get a 35% drawdown on your whole portfolio, like in a week or two, like you could have seen. And I've seen the emotions to where it's tough. Like, so were you more comforted that you're sitting on such big unrealized gains to where, you were able to be even keel and it didn't affect you that on paper you lost a lot of money over the last couple of weeks?
It's a good question. I'll say this. I think without a doubt, the success that I've had over the last year or two definitely gives cushion to my emotional state. I think I'd be lying to myself if I didn't admit that. That said, I know, and I'm quite frank with myself in terms of I don't think I lie to myself that often, at least, that I was prepared to see a 30% drawdown going back a year, even after, and I've talked about in presentations, like if you go back to 2022 and 2023, I had a couple really tough years in terms of some mistakes I had made, but I was super confident how I changed my process, how I changed my portfolio and how I had it allocated, that while it sucks and it didn't feel great seeing the portfolio go down or even surmising that it might go down, I was pretty confident in how it was constructed and where it was headed. And I would say that's very much of where I stand now. And again, I link that to progress as a person and progress as an investor. And I think that I also borrow the confidence that I see in those people that have helped me get where I am, in talking to them. Like I described this, in 2019, walking down the road in Singapore, and talking to this friend and mentor of mine about, buying and selling and talking about market crashes very conveniently right before we have this COVID crash. And like the stuff just like sort of downloaded into my head and made so much sense. And I think, as an investor or anybody listening, like you're going to have moments like that where things are going to click in. And that's sort of why I alluded to, even if you don't get this completely right, and maybe for a bunch of you won't, but it's just going to be such a good opportunity for you because there will be moments like this into the future. Absolutely no doubt. And you can look and you should look at how you performed, how you had your portfolio set up, what all those steps were that you took, either before or after, either right or wrong, and parlay that into the future. And it's just so important because that's how you kind of bring your process together. And like one of the biggest questions I've had over the last couple of weeks, and it's something I try to teach and lend my experience in my newsletter, is talking about portfolio construction. And there are so many guys I was very happy to meet a bunch of subscribers at PDAC and some other people that wanted to talk about this. And I could see how one of the big problems that people had was misallocation of funds. And even though it's something I put in the newsletter, there are some stories that seemingly resonate with certain investors, and they want to put 25% of their portfolio focused in one name. And I like that. I get where that comes from. I've been there.
Where does it come from? If I could interrupt.
Greed. It comes from greed. It comes with a mesmerization about how much money I could make if this is right. And so I get it. And I can see it instantly when I'm talking to each individuals. And again, you go to the emails I've had over the last 2 weeks, and it's like, well, what about portfolio reallocation? Because what people are doing right now is they're acting on fear, and they're looking to rebalance their portfolio when at the point when they really shouldn't. You know, like you should be, like I say, you should be ready for sort of these events before these events happen. And I think ultimately that's what's going to make more successful investors over time. And looking back, if people have that introspection, they should look back and say, hey, like I should have been ready for sort of this. And I should only really be in names that I really believe in. And I should be allocated the right way. So whether it's the COVID crash, whether it's conflict in the Middle East, I can sort of weigh those ups and downs. And if I lost because of a drill result, or I lost because of this, it's not going to blow me out. And again, like I think those are some of the points that you want to sort of digest yourself. And we'll see how the next couple of weeks go.
Okay. So as I'm listening to you talk, then I'm processing my own psychology. And one of the reasons why over this last couple of weeks, I've been more stable is that I've been focusing on private opportunities. I've been deploying my capital into for private future ongoing cash flow opportunities. So I guess in regards to my finances, that just brings a level of, mining stocks go up, mining stocks go down. I'm going to always seek to take advantage of those opportunities. However, when you have consistent cash flow and you're deploying money from an investment standpoint into things that are going to produce future cash flow, I guess that's why like that kind of calms your emotions. And that goes back to my earlier point for a lot of listeners. If you've put too much money into junior mining stocks that should not be in junior mining stocks, it's nice when they're going up, but when they go down like they have in recent times, that's when it can throw your emotions out of whack.
100%. And I think, especially as you develop as an investor and where you like to be, those other opportunities, or even because I still view junior mining sort of as floating abstractions, each individual company where the valuation really is just at the expense of the market and how they view it. It's like that sentiment means so much. And so again, when you have profits, it goes back to the stuff again, we've sort of touched on it before, but taking money that you've made in junior mining and putting it into real things, whether that's new businesses, like real businesses, your education, paying off your house, paying off your car. Those are all really good things to be transferring money to, and should give you some comfort when you hit times like this, and keep you more level-headed and not as prone to succumb to the emotional swings that undoubtedly I look at the next like 3 to 5 years and all the things that could happen. I think we're going to be tested multiple times with situations like this, unfortunately, and you're going to have to keep your wits about you, or it does kind of run the risk of blowing you out of the market.
Excellent. Opportunity cost, Brian. That's what I've been thinking about the last month or so, in terms of portfolio, personal life, and business, and just making sure that I don't deploy capital or time into something that will ensure locking it up to where I can't pull out of it to deploy to a new opportunity, and also not pursuing opportunities that would require too much time to where it would detract from my personal life. And of course, how you make those decisions, like your values, govern how you view those things. But in terms of like, we're talking about portfolio construction, but I've also brought in business and then personal life. So for example, I would rather make less so I could spend more time with my family but yet be content and happy with keeping what I've obtained, but I'm not going to pursue endlessly with my time and my money something if it's going to cause me not to be around for my kids or my family. And so that's the big thing I've been thinking about over the last month is opportunity cost through that lens.
It's a really good thing to contemplate, I think. And probably, talking about the volatility and the sort of uncertainty that we'll face in the next 3 to 5 years, just with like this sort of monumental transformation the world is going through. I think I hope that sort of question comes up in a lot of people's minds, because I think it's probably been one of the things that's been lacking across the board. But I'll talk about Western society, especially Canada, the States, probably Europe too, where I think people's priorities for the most part have not necessarily been in the right place. And maybe hard times, and hopefully they're not as hard as I think they could be, we'll have people reevaluate what's most important to them. And it's certainly something I think people need to think about, because it matters more and more, and especially talking about how people passing that you don't expect, and that's sudden. It shows you the reality of the shortness of life. And again, not to get too or down
there's a lot of bear market philosophers. You can get into deeper things if you want,
No, but I just I'm just like one of the news releases I saw this morning about somebody passing in the industry, and you just think it made me think about the shortness of life, on how quick it can go, and if everything seems rosy and then all of a sudden it's not, and it's
and how much, even though the show is about making money, how much money do you need to be happy, right? Like if you can be content with 100,000 in the bank, then that's an achievement in and of itself, in my view, in terms of your priorities. Right. And then even like if you have 10 billion in the bank or you have 20 million in the bank, like does that delta between 20 and 10 million, does that really make a difference in your life? And so those are things, to think about. What are some other things you've been thinking about, Brian?
Well, how about just generally talking about books? Like, because I think maybe that's why my thought. I'm reading the Gulag Archipelago right now, which is a pretty heavy book, and that's on this sort of, even though it's based off true. I'm not sure the whole story is necessarily true, but true events, and it's. And hopefully that doesn't happen again in this world, but maybe that's where my head's at. But I'm also reading a book on Peter Cundall, and that was sort of inspired by talking or listening to Rick and the massive effect that he had on his life. And so I'm reading it's basically like a biography, which he's a pretty famous investor from a number of standpoints. So I'm reading those two books. And I'm headed to South America, to Uruguay, this weekend for a site visit. And I intend on getting through those books as a 12.5-hour flight down there. And
is that for field notes?
No, it's not for field notes. It's investment in a private company that's going public probably in the next 3 or 4 months. Going down to see their project. Uruguay is a country that has been off the map from, the mainstream junior mining or mining sector for a while now. And these guys, I think there's maybe 1 or 2 other juniors down there, but they definitely have, the company Sun Valley has the dominant land position and I think really good prospects. It's an orogenic belt. Some historical drilling on the property from.
Weren't they in North Africa, that company? Or is that a different company I'm thinking of? Sun
Valley it's been private, and they don't even have a website as far as I know anyways. I don't think Christo's a pretty young guy, so I don't think he's
okay. I'm
pretty sure this is his first kind of foray. I could be wrong though. But I'm going down to see the project, spend more time with Christo, the CEO, and get a better lay of the land. It's a really interesting part of the world from a number of standpoints, both historically, but then I think the geological potential is excellent. And it's where a lot of expat money from the West has sort of gone over the years to sort of hide out, I think. And so it's a really interesting part of the world. Montevideo has got a lot of very rich people there. And so I'm quite interested to kind of take in the whole experience, both culturally and to see what they're doing with their mining projects. So I'm reading those books. What are you reading?
I haven't been reading that much, to be honest. So like listening to stuff, but over the last, I'd say a year ago, I read this book right here, Eavesdropping on Millionaires, Investment Strategies and Advice on How to Build and Maintain Wealth by John Malden and Tiffany Malden. I think that's his daughter.
Okay.
And where this is good, Brian, and I read the whole thing, and I was, when I was going to site tours like 12, 18 months ago, I would always read it on the book the whole time. And it profiles people that the authors knew over like a 20 or more year time frame and how their wealth grew, to where the individuals from different sectors, careers, business owners shared insights as to how they grew their wealth. And they talk about their risk profile. They talk about some of the ups and downs, the best and worst decisions, key takeaways. If you could do it over again, what would you change? And I think, you know how we were talking about a crisis in the moment here. We're talking about, okay, your portfolio goes down 35% because of the war in Iran, right? Well, if you can even step back and interpret what you're currently in with a wider, broader, longer time frame, and you, of course, I'm 47 years old now, so maybe I'm trying to think more like an old man, but not just as a 32-year-old that's trying to increase his wealth, but reading other people who are in their 60s and 70s and 80s, how they look back on how they made all their money, and just getting that breadth of perspective. And none of them talk about mining stocks, but it's just seeing that breadth of perspective and then reflecting on like, okay, what am I doing now? And how in 10 years might I interpret what I'm doing now differently? Mm-hmm. And then looking back, my last 10 years as a resource investor, what has worked? What hasn't worked? And with that lens, then that gives you confidence or courage when you do see a good opportunity. And so like when you talked a second ago about, you know, it drops off and it may not be the bottom. Well, I remember what Rick Rule told me in one of our interviews over the last year. I asked him about that. I said, when something sells off, you know, how do you know that this is the moment when you should have courage and you should go in? And he said, Bill, because I tell myself it's cheap enough, even if it falls. Yeah. And so like even the company that I bought this last week, I knew it could fall more because that's just how markets are. Like it could fall 40% more, but I said it's cheap enough and they should be cash flow positive by the end of the year and then cash flow increasing next year. So I said, if they execute, there's always execution risk, but if they execute, I don't have to worry about dilution, and it should be a growing multi-year business moving forward, and it's cheap enough even knowing that it could go down. And so and part of my last 10 years of experience caused me to take advantage of that opportunity. So this book, going back to this is about listening to other people that made money, how they did it, and what they have learned from it. And then another one in the last year I've read is this guy right here, Deep Value by Tobias Carlyle. Why activists, investors, and other contrarians battle for control of losing corporations. And this is about companies perceiving opportunities when companies seem to be on the brink. But if it can be restructured, if there can be new management, if there can be a slight change in the business plan with the right people coming in to catalyze it, then it's an excellent opportunity moving forward. But how do you discern when it's a good opportunity and when it's just a piece of junk that should be discarded? And so in a personal level, a couple years ago, I was an investor in a company in which the investors and I decided we have to figure out if this thing is worth saving. And it was a very stressful process to where the management that was removed put it in a terminal spot and it wasn't worth saving. So that experience led me to this book, and I hope can help be a better investor. And that goes back to my earlier point about opportunity cost, Brian, because the months it took to figure out if the company was worth saving or not were so stressful that my quality of life decreased by such a degree that I said, I'm going to be careful to lock my capital up in companies that if it goes bad with a big check, it's going to decrease my quality of life. And if I deployed that money into Agnico Eagle or whatever, I would have had zero stress, Brian, and it would be up 4 to 5 times. So that's also why I've been thinking about opportunity cost, because during that period of time, just to tell an anecdotal story, when my son was playing basketball and my daughter was playing volleyball, and I would go into my daughter's volleyball tournaments in these big gymnasiums, I was so stressed out and not sleeping for a couple months properly that I would walk in and all the noise of the gym would like ring in my ear to where I couldn't even just sit in the bleachers like I always had. And I literally had to go to the bathroom, get a bunch of paper towel and stuff it in my ear just to deafen the sound. And then I had to buy earplugs just to go in the game. And I'm like, what's wrong with me? Then when I moved past that, and now the next year when I went in the gym, I'm like, man, there's nothing wrong with my ears. It was just, I was so stressed out. My cortisol levels were so high that I couldn't even enjoy a game. Like the physiological effects of that stress wasn't worth it. So I'd rather make a lot less money, but be able to just enjoy my family and my life, Brian. So that's one of my big takeaways in terms of opportunity cost.
Yeah, totally. And I think it's interesting when you bring up talking about it's cheap enough. Like I think that a lot of investors get so, especially when times are sort of uncertain, they get too wrapped up with certainty, and that's what keeps a lot of people on the sidelines. Like, is it cheap enough? Is it? And it's probably one of those things where I still think that there probably isn't enough work done to sort of give confidence to the investor that it is cheap enough. So you have to be able to have a value in mind. Like when you're looking at a company and you say it's worth $100 million and it's selling for 20 million, and depending on where that company is in its development, it should sort of ring true that, a differential of 5x on that valuation, like you came up, that's worth 100 million, it's selling for 20, yeah, it could go lower. And in that case, one of the Buffett adages is like, it's an opportunity if it goes 50% lower to buy more. And so I think that's maybe one of the biggest things is if you can gain more certainty in an uncertain market by doing the work and understanding the value of the company, and have like that quantitative approach anchors it for you. And yes, it could go lower and you have no idea where the market is necessarily going. Nobody does, but there's differentials that should set you up from a quantitative level that should tell you that, yes, it is indeed cheap enough. And I think when Rick talks about that, especially coming from Rick, I think this is what it's rooted in. And you can get into all the qualitative aspects of the company too. And I think that might get more, like, especially when you talk about exploration companies, it's probably more abstract and you have to have a lot more experience to maybe gauge that differential or that price to value opportunity. But when it comes to the developers, the producers, the royalty companies, these things that have quantitative metrics, you should be able to write it out to yourself and say, hey, this is the opportunity. Is it worth the risk right now? Like if it's a coin flip, what's going to happen in the conflict in the Middle East, and I see a 1x on a company that I want to invest in, is it worth that coin flip? And the downside being I'd probably lose 50%. So maybe for a 1x, it's not. Maybe you need to look at something that's 3-4x type of opportunity, maybe regardless of where the market goes, that gets you to say, okay, I'm willing to take that coin flip of whatever's going to happen in the Middle East. I'm able to deploy that money, and I'm able to deploy it because I see a 5x differential in price to value ratio. And I think, again, the more the more quantitative you can be with your approach, the easier it is to be certain in uncertain times. And like, I think that is such a key component to, again, listening to different people and trying to act a certain way. Cause like you need this part and then you need the other part where, for me, I needed a mentor sort of to like drive it into my head. Like if the world is truly over, does it matter if my money's in my bank account or in my trading account? And again, that might seem like a pretty simple notion to a lot of people that are brushed off. But when he said that to me, I don't know, I just thought to myself, like, that is absolutely right. If everybody's fearing that everything is over, then it makes no difference whether my money's in my bank account or my trading account. So if I have a good opportunity that I'm fairly certain on my valuation skills and I see the opportunity, I should be a buyer.
And that fairly certain, but never 100% certain you're going to make money in terms of the result. You can be certain of the risk reward setup that you see, right? And the valuation you put on the company, but the end result, because I was prodding a friend once because there was a company we invested in. It was a Explorer that has recently been trading 6 times higher than when we invested. I actually sold for a loss before the discovery, but because he held on, he was saying to me, I just knew this was going to work out. And I kept saying to him, you didn't know it was going to work out. But when you're up 6 times, you get this confidence to where you say it was because of me. And I said, you did not know. And case in point, you interviewed Andre Gamon for the show like 2 months ago. He laid out his 5-point strategies for how he would build a $1 billion company, and he did it. And you focused on the Eleanor discovery there in northern Quebec. But Andre's on record saying, if you would have asked me before we made that discovery, of all the projects I had in the portfolio, which one was going to hit that year, it wouldn't have been Eleanor. That's him saying it. So he was confident in his process, but you don't always know where that big winner is going to come from.
No, you don't. And, honestly, and here's the thing is, the type of attitude, okay, everybody can be susceptible to thinking or confusing a bull market with brains. Everybody, and at different points, and it's to what degree, right? But the truly delusional ones, which whoever this is you're talking about, like, and I imagine they held on just because they didn't want to take the actual loss like you did. They just held on, again, coin flip probability way against them, especially when it comes to exploration. Those people will give those winnings back very quickly because, again, they will mix up. That's
why I was busting his chops, Brian, because I was like, this one was not on your smarts.
You knew right away, and that shows you, the experience that you have. That and the experience comes in, like an investor will take losses when they're there, and you take it for the right reasons, right? And I'm sure there was a lot of right reasons why you did, and then someone less experienced that's more susceptible to the emotion that's behind selling, sits there and then attributes themselves somehow, like you said, to the success. And then what they'll do is they'll take that money and they'll put it into maybe 1 or 2 other things that they think that they really understand, but they don't, and they'll end up losing it. And it's a shame. But again, that can ultimately be a good experience because then they'll have that self-actualization that, hey, I need to brush up and I need to take less risk, especially when it comes to exploration. So having made some of these mistakes myself, I'm just speaking from experience. But those things always come full circle. And so for anybody that's looking on the outside, you say that and then you kind of move on because this person's going to have it come back at them at some point. And it always does.
Excellent. Well, Brian, safe travels to you and to our listeners. Thank you for listening. We got more interviews and shows lined up for you over the coming month. We appreciate your listenership and hope you manage your portfolios well through these turbulent times. Thanks for listening.